Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, May 2nd. You are tuned in to On Trend, the show designed to keep you on the right side of the trend. So today we're going to dive into the best 6 months strategy, which really is the best 8 months, as we're going to find out. We'll review the classic 6-month strategy. We'll look at the seasonality charts. We're going to add some market timing. And we're going to show you what happens when you add TLT to the mix. And this is all going to be back tested over a 20-year period. So the best 6-month strategy was developed by Yale Hirsch, and his son Jeffrey is taking over the business. And it is of course, the Stock Traders Almanac that you can see there. And there's their website, Stock Traders Almanac. It has been around since the 50s, this strategy, so I'm going to put it to the test. And just to recoup, the best 6-month strategy says that the best 6 months of the year are from November to April. Consequently, the worst 6 months are from May to October, so that's where sell in May and go away comes from. So here we have a sharp chart with the 6-month cycle, and you can see the bearish cycle in May begins when you have the red line and the red arrow, and then the bullish cycle begins there in November when you have the green line and the green arrow. And of course, it's not a perfect setup or system. You can see in 2008, it was a very timely. You would have gotten out of that big decline during the financial crisis. You can also see in 2011, you got a bearish seasonal pattern there and the market went down. But you can also see that we had a bearish seasonal pattern there in 2017 and the market went up. And we had a bearish seasonal pattern in 2018 and the market went up. And the only way we can really see if this works or not is to go back over a significant time frame and back test it. So let's do that. So before looking at the back test results for the 6-month strategy, let's set the stage and see what our benchmark returns would be like. I've got a chart here with the S&P 500 and SPY showing performance over a 25-year period. And you can see there's a big discrepancy. SPY is up like 916% over this period, and the S&P 500 is only up 543%. And the reason is the SPY data on stock charts is total return, so that includes dividends. And so that gives it kind of an upward drift, we'll call it dividend drift. The S&P 500 index does not include dividends. And you can see over a 25-year period, dividends do make a big difference. So when we do our test, we're going to use the S&P 500 for the actual signals, because we're going to use a 200-day later on here with this seasonality pattern that we're seeing. And we're going to use SPY as the trading vehicle. Now, just to illustrate this dividend drift issue that I'm talking about, you've got the S&P 500 in the top window. You can see that blue line. Well, the S&P 500 is just now at that high from September and October. And you can see SPY, because the dividends are added back into it, moved above that September-October high. Similarly, we can see the highs here from November, December, whereas SPY moved above them. And then you look at the S&P 500, it did not. And then we had the S&P 500 crossing below the 200-day in early March, but SPY did not. And so that's why when I look at SPY, I want to take my signals from the S&P 500 because it doesn't go through these adjustments. So here's that chart again with SPY. And again, if you did buy and hold with SPY over this 25-year period, you would have had a 9.86% compound annual return, but you would have had a maximum drawdown of 55%. And of course, that was during the financial crisis. And you can see after the dot-com bubble burst, you had another drawdown of around 50%. So you would have had to live through these two drawdowns. And if you just used a 200-day moving average to time the S&P 500 and then use those signals to trade SPY, you can see your drawdown would have been cut in half to 26.5%, and your compound annual return would have gone down by around 25%, 7.7% compound annual return. But you can see you would have gotten out and missed the majority of this decline. And you can say, well, the market always comes back. But, you know, how are you going to feel when the market is trading down here and your portfolio is down 50%? That's a whole different ball game. And that's why I think we need to use some sort of market timing. So what we're going to end up doing is we're going to show the seasonality patterns, an adjusted seasonality pattern, and we're going to add market timing and TLT to the mix. And here's a table reinforcing what I just showed on the chart below. There is the buy and hold return in the first line, on the first line there. And then if you use the S&P 500 cross, you can see you had a lot of whipsaws. You would have had 31 winners and 61 losers and a win percent of around 33, 34%. But your average gain was much greater than your average loss. And there you can see the drawdown relative to the compound annual return. And that is the risk-adjusted return because it is higher because you were only in the market 73% of the time if you use the 200-day for timing. All right, so if we take this same 25-year period and instead of using a 200-day for timing, we use the 6-month seasonal pattern for timing. And so that means we would buy from November to April and hold. And then in May, we would sell and go away until October. And you can see the compound annual return was around 7.34%. And you can see for the other 6-month period, the compound annual return was 2.13%, much lower. So there's clearly a stronger upward bias during that 6-month period from November to April. And you can see exposure was split, and you can see the risk-adjusted return. And you can see you had more winners than losers. Even so, even though you had more winners than losers during the worst 6 months, you still didn't get much return at all. And there you can see the average gain relative to the average loss. The average loss was more than the average gain during the worst 6 months, but it was slightly better during the best 6 months. Now, I went to a seasonality chart and just looked at the monthly performance for the S&P 500 over a 20-year period, and it's clear that there's really an 8-month seasonal pattern at work where there's 8 good months and 4 bad months. So here I am on the charts and tools page, and you can see the seasonality link over on the right under charting tools. I can also scroll down and I can create a seasonality chart here. So I'll just enter the S&P 500 and I will get my seasonality chart, and it'll be for a default of 5 months. I'm going to go ahead and close that window a little bit so you can see it. 5 years, excuse me. And I'm going to open that up to the maximum of 20 years. So I went through the numbers on this seasonal chart, and you can see this is a percentage of time that the month is up, which is 63% there in August. See, best month is April, 75%. And then this is the average gain or loss. So August was an average loss, actually, even though it was up 63% of the time. November, the average gain is 1.1%, and it's up 74% of the time. So what I did was I added up the 4-month totals for the percentage of times the S&P 500 was up. And this 4-month window here from June to September has the lowest as far as the percentage of times that the S&P 500 was higher. You can see there's a 4-month window from December here until January, February, March, which is fairly low, but that is not as low as this period from June, July, August, and September. So I would suggest that the worst period for the market is this 4-month period that includes the summer and early autumn. And the rest, the other 8 months, are a bullish period for the market that goes from basically October until May. You can see May, the market is up 65% of the time. That is the 4th highest percentage of the 12-month of these 12 months over that 20-year period. So here's what it looks like on a chart over the last 4 years or so. You can see there's the best 8-month period going from October until May. Very choppy period in 2015-16, but the market did close higher. The worst 4 months then followed. The market was still higher, but not by much. And then you can see the best 8 months started in 2016-17. The market was sharply higher. It continued higher during the worst 4 months. And then the best 8 months also higher, but you had that volatility. And then the worst 4 months continued higher. And then the best 8 months, you had this huge decline and this move back up. So you went nowhere, but you had to sit out through this big drawdown. So I ran the test using the best 8 months by going into the market, using SPY as a trading vehicle, and getting out during the worst 4 months. No other timing than those two signals, basically. And so if you were in the market just from October to May over the last 25 years, you would have had a 9.92% compound annual return, 10%. And you would have been in the market just 66% of the time. You still would have had a big drawdown. So we got to figure out a way to reduce this drawdown, and we're going to add market timing next. But this is what's also very interesting. You look at the bearish 4-month period from June to September, the return was 0. All right, you were exposed to the market 33% of the time, and you had 0 return, so nothing to show for it. So clearly, it's not worth being in the market for no return during that 4-month period over the last 25 years. So here's what we got so far. We can see that if you use the 200-day moving average for some basic market timing, you can get a decent return, 7.71%. But most importantly, you can reduce the drawdown. Your drawdown cuts in half, and your exposure to the market's only 73%. And then you can see if you use the bullish 8-month period from October until May, you can see that you get a decent return, almost 10%. Your exposure is around 66%, and your drawdown still pretty high. So we need to get kind of this return here, and we need to get this drawdown. So let's see what happens when we combine this seasonal pattern with the 200-day cross. Now, before looking at the numbers, note that I've had to correct the original back test, a bit of a mea culpa here, because after studying the numbers and the trades, there was some future link. The systems that tested the best 6 months, best 8 months, those are robust. But when you add a moving average cross signal, then you need to add a trade delay. So you get a signal on the close, and then your buy sell is on the next open. And so I made that adjustment. The results are not as good, but they're still okay. So let's take a look. All right, so previously we've been using just a 200-day and a cross above and below the 200-day, but previous work that I've done has shown that if you just smooth out that process by using a 5, 20, or even 50-day moving average, you can improve results in that you keep most of the return and you reduce the drawdown as well as the number of whipsaws. So we're going to move to my preferred moving average pair, a 20-day moving average and a 200-day moving average. So the way this is going to work is when we're in the best 8-month period and the 20-day SMA is above the 200-day SMA, then that's going to be a bullish signal. So it would be long the market, as you can see here. We begin in October, the bullish period, 20 days above the 200-day, and we ride that. And then when the worst 4 months hits, there is no position, regardless of where the moving average is. Then the best 8 months hits, and the moving average, the 20, is above the 200 days, so that position remains. Worst 4 months hits, and there is no position. And then you can see this is where the moving average pays off. All right, we had the big decline in October, November, and then the 20-day move below the 200-day. So even though we were in the best 8-month period, that position was closed because the market trend had turned. And so basically flat or in cash. And then later on, you can see this year we had the 20-day moving above the 200-day in February, March there. And so we're in a new position right now. So at this point, we have basically 3 systems to compare, or strategies. The first one is to trade SPY based on a cross with the 20-day and the 200-day moving average. And you really need to focus on these 4 metrics, I think, to get an idea of what's going on. But using just that for signals over the last 25 years, you had a 9.61% compound annual return, exposed around 73%. Risk-adjusted return was double digits, 13+%, and the maximum drawdown a very respectable 19%. There's a rehash of the best 8-month strategy, and you can see it's got that big drawdown. And then if we combine the best 8 months with market timing, you can see the compound annual return is lower. It's down to 8%. But here's the big benefit. You get the low drawdown. The maximum drawdown was 14.4%, and that is quite good. It's a lot easier to live through a 14% drawdown versus even a 19% drawdown. And also, you're only exposed to the market 48% of the time, so you could have done something else with your money that other 51, 52% of the time. All right, so I wanted to look at a possible option to SPY during the bearish 4-month period, or when the S&P 500 is below its 200-day moving average. And of course, the natural options would be bonds, because stocks are the ultimate risk-on investment or trade, if you will. When risk is on, higher risk equities tend to outperform bonds. Bonds, of course, especially treasuries, are the ultimate safe haven. During times of uncertainty, that's where money is going to gravitate towards bonds. So what I've got here is I've got the seasonality chart. And as I said, TLT doesn't have a history going back as far as SPY. I've got 18 years on this seasonality chart. And what we can see here is here's the summer period, and that's the period that coincides with the bearish 4-month period for stocks. So if we go from June, July, August, and September, we can see that the biggest month for bonds is August. 76% of the time, bonds are higher in August. And if you look at this period from January to July, you can see that bonds are up on average 50% of the time, 55% of the time. And, you know, the other big month is November outside of this summer period. But if you add any 4 consecutive periods together, the 4 highest are going to range during that worst 4 months for the stock market, which goes from June until September. And so that suggests that we have a bullish period for bonds during this worst 4-month period for the stock market. All right, so what is the trade here when we add TLT to the mix? Well, we want to base it on the S&P 500 and the worst 4 months. So we buy TLT when the S&P 500 20-day moving average is below the 200-day, or when we're just in the worst 4-month period. Now, conversely, we will buy SPY when the 20-day is above the 200-day and we're in the best 8-month period. And when you combine those two, you're pretty much 100% invested in either one. All right, let's look at some of these signals for TLT on the chart. And at the top, on the top window, we've got the S&P 500 with the 20-day moving average in green and the 200-day in red. And there you can see the worst 4-month period, June, July, August, and September. And so you would go long TLT. And that first trade in 2016 had a 5% gain. And then you can see the 20-day was above the 200-day during the bullish period after that. So we were long SPY. And then we had the worst 4-month period for the S&P 500. And so we went long TLT, but that trade resulted in a 0.2% loss, basically flat. Then we had the bullish season, and the S&P 500 was above. Its 20-day was above the 200-day, so we were long stocks. Then we had the worst 4 months and went long TLT, and that resulted in a 2% loss. And then when the S&P 500 broke down there at the end of October or beginning of November 2018, got long TLT, and then got out when the 20-day crossed above the 200-day for a 6.7% advance. Now, I would love to do the 25-year test on TLT, but as you can see, TLT did not start trading until the second half of 2002. S&P 500 and SPY, of course, have been trading since 1994. S&P 500, of course, for a lot longer. So for that reason, I had to start my test basically in August 2002. And so you can see that kind of coincides with a bottom in the stock market. Now, believe it or not, the place you start to begin your tests can affect the results. I know that's not hard to believe. For example, if I'm running a bullish test on the stock market over a 10-year period, well, it really doesn't make sense because look at that advance. I need to have a couple of market cycles to have a robust test. So I think to have a robust test, you need to at least go back to 1999, 20 years, so you capture the two bear markets that we had, and you have a more realistic outlook as far as, you're not just looking at a bull market like we've had for pretty much 10 years. So let's look at the results. Now, as you can see, I've had to adjust my test period as well for SPY using S&P 500 timing and the best 8-month strategy. And you can see that the compound annual return is less, 6.61%. You're only exposed to the market 50% of the time. So your risk-adjusted return is pretty much double because you're only in the market half the time. And your maximum drawdown is a very respectable 14.38%. Now, if we just test TLT, you can see that it is invested the other 50% of the time. So you're buying TLT during the bearish 4 months or when the 20-day moving average moves below the 200-day moving average for the S&P 500. And you can see from these results, you have a 4.73% compound annual return for being invested half the time, which is not bad at all. There's your exposure, 50%. And your risk-adjusted return is over 9%. Now, the big drawback here is, of course, the big drawdown. You had a 26% drawdown, and that was in 2008 during the financial crisis. The rest of the drawdowns were in the 10 to 15% area, so this was an exception. But, the exception, as Cesar Alvarez always says, your biggest drawdown is in the future. And then you can see the winning percent was 55% for TLT, much higher for SPY, 75%, and the average gain and average loss was respectable for both. So if you want to add something to this system, you can consider TLT, which of course is the natural alternative to SPY, stocks, risk, bonds, risk off, or safety. And if you have any questions, comments, or general feedback, you can always reach out to me. My email is askarthur@stockcharts.com. I can't promise to answer everything, but I will read it and take it into consideration. And you can also follow me on Twitter. So here's the S&P 500. We're still well above the 200-day moving average, which is right there about 2770, the red line. And we just hit a new high. And we still have about a month to go for the 8-month, best 8-month seasonal pattern that we're seeing in the S&P 500. So in June begins the worst 4-month period. And keep in mind, that's not necessarily bearish, but it does tend to be a time when the market struggles. And you would have to be concerned about this upcoming period because you can see the S&P 500 is up 25% without any kind of a pullback. The biggest pullback was 3.5% from high to low. And that's really not even a correction, if you will. That's just a minor noise pullback. Now, a garden variety decline could take the S&P 500 back to that 2,800 area. You can see this resistance zone here and kind of a breakout there, and the 200-day is there. So, a pullback to 2,800 would be perfectly normal and might be the pause that refreshes. Now, as far as turning bearish on stocks and saying I don't want to be in stocks, I would look for the 20-day moving average there to close below the 200-day moving average. And if RSI breaks its bull zone with a move below 40, that would be a bearish development. Now, when we look at bonds, of course, the seasonal pattern for bonds does not turn bullish until at least June. And as I showed, August is by far the best month for the bond market for some reason. But if we look at the TLT chart, we can see a bullish pattern. There's a big inverse head and shoulders of sorts. And then you can see the breakout. And then we have a pullback to the breakout zone. So broken resistance is turning into support. And we have an upturn off of this broken resistance turn support zone. So it looks like bonds are poised to bounce. They're above the 200-day moving average, so that's positive. And then if we look at the 30-year Treasury note, 30-year Treasury yield, you can see a bit of a breakdown there. First we had the decline, then we have kind of a wedge and a break below that wedge line. So I would be bullish on bonds at this point and expect them to move higher even before the worst 4-month period starts. So the Russell 2000 continues to struggle. We can see that there's this resistance zone in the 158, 159 area. And you can see it hit this area in late February, came up to it in April a couple times now. Now this little breakout here from the falling flag or wedge is still holding, and we're still largely above the 200-day. But I would mark kind of a support zone there. And if you move, say, below 154, that's going to negate the breakout. And also this cup with handle that is taking shape would be negated because you move below the low of the handle. So that's what to watch as far as IWM is concerned. One sector that I would be particularly concerned with, probably even more than healthcare, is this energy sector. You know, it's only 5.5% of SPY, and it's dominated by ExxonMobil and Chevron, but it has the weakest chart out there. First of all, you can see it's below its 200-day moving average, and that 200-day moving average is falling. And if we do some Fibonacci retracements from this high to low, and that would be the decline from October to December, you can see that we're right near that 61.8% retracement. That's where we're running into resistance. So this is kind of a level to watch here. I'll go color it red since it is resistance. So we've come to this Fibonacci retracement, 61.8%. We've come to this red resistance zone. We've come to the falling 200-day. You could even draw a rising wedge of sorts if you want. You know, the trend lines are pretty subjective. You know, I don't think you can draw a trend line from here because that's too steep of a move. But clearly, you know, you're breaking below the trend line and you're on the verge of breaking below the late March and the April lows with this decline that we saw yesterday. And if you look at RSI, it broke back into its bear zone, and it didn't even get above 70 when the energy SPDR was moving higher. So momentum was never really that strong in February or March or April because RSI couldn't get above 70, and now it's broken back below 40 and out of its bull zone. So energy is looking quite vulnerable here. And finally, retail is not looking very hot at all. This is the XRT, which is a very broad-based retail ETF with something like 100 stocks. And we can see that, you know, it got up to the 61.8% retracement in February, but while the market moved to new highs, it's forming a lower high. It can't get above it. It's below the falling 200-day moving average. You can see during the advance, RSI couldn't make it above 70, so you didn't have momentum. So this one is looking vulnerable to further weakness. All right, that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend. Have a great day.